Hello all of you. Okay, now we'll continue. So here we have discussed about the concept of what do you mean by buyback. Buyback means the cancellation of equity shares. Okay, cancellation of equity shares. So why we do the buyback? The buyback we do to increase the earning per share, to increase promoters holding, to and to support the share price in stock exchange when share price in market is less than its worth. And if you have surplus cash, we do buyback. Now, as per section 68 of Companies Act 2013, we can do buyback out of fresh issue of shares and we can do out of profit. Section 68 does not talks about the fund. It talks about the replacement of capital should be with the capital. So if I say it is out of fresh issue of shares, we decrease the capital by 2 crore. At the same time, we have to issue the shares in the market. So there should be increase in the capital of rupees 2 crore. But what happened if it is we have issued the shares in the market in premium? So the premium amount is irrelevant, and what amount we have received, section 68 not talks about it. Section 68 says that the replacement of capital should be with the capital. If you have decreased the capital by rupees 2 crore, then there should be increase in the capital by rupees 2 crore. Now another way to do the buyback is out of profit. In case of out of profit, we are not issuing the fresh issue of shares in the market. In that case, section 68 says that we have to transfer to a new reserve which known as CRR account, capital redemption reserve account. So we know that when we transfer from free reserve to CRR account, we are not increasing the capital here, but this CRR account can be utilized only and only for the purpose of bonus share. So when in future we will issue the shares, bonus shares, so at that time we cannot receive the amount, because when we issue the bonus share, because bonus shares we issue free of cost. So we cannot utilize the we are not going to receive the amount. So we are going to utilize reserve, and that other reserve we can also utilize for bonus issue. But here I am talking only for the CRR. So at that time we will debit to CRR account. So entry will be CRR account debit to equity share capital account. So in future when we will issue the bonus share, equity share capital will be increases. So here you have decreased the capital. In future the capital will increase. Here you have decreased the capital. In the same amount we have increased the capital. It may also happen that the buyback of share is a combination of both. What do you mean by the combination of both? It means that it may be some portion is out of fresh issue of shares and some portion is out of profit. So we will discuss about it later. But right now you have to understand there is two ways to do the buyback. The section 68 not talks about the source of fund. It not talks about the source of fund. It talks about the replacement of capital should be capital. So first way, we do the buyback, but at the same time we issue the fresh issue of shares in the market. So capital is replaced by capital, because when we do the buyback we reduce the capital. When we issue the shares in the market we increase the capital. Second way is out of profit. We do the buyback, we reduce the capital, but right now we have not increased the capital, but we have transferred to a CRR account. Later on when we will issue the bonus shares, this CRR will be utilized for the purpose of issue of bonus share. At that time equity share capital will be increased. Okay, so here you can see now in your study material which is provided by BB Virtual Studio, that is I am writing in page number 3. So I strongly suggest you have to write it with me. That will help you retain the point for a longer period. But I will also share after the completion of these all the concept discussion, I will share this concept builder also. Okay, so in the PDF form you can download it from the link of Google Drive which is provided to students. So you can also download the concept builder, and daily I will share these class notes. Daily I will share this whatever questions I have solved in class. I will share the PDF of that also. Obviously you have to solve with me, but for your reference I will share the solution of every day. So if in case if you miss any point, you have not written any point, so you can write it on later also. Okay, now write down in the study material. When I say study material, it means the book, this book you have, this book. Whenever I say study material, I am talking about this book. Okay, so here write down in your study material. First write down there meaning of buyback. Meaning of buyback. Write down there. Meaning of buyback. Okay. So write down there. Buyback of shares. Buyback of shares means purchase of its own shares. Purchase of its own shares by a company. When shares are bought back, by a company, when shares are bought back by a company, they have to be cancelled. They have to be cancelled by the company. They have to be cancelled by the company. Thus, they have to be cancelled by the company. Thus, they have to be cancelled by the company. Thus, shares. Yes. Thus, shares. Buyback results. Thus, shares buyback results in decrease in share capital. Decrease in share capital of the company. Decrease in share capital of the company. A company cannot buy its own shares for the investment purpose. What does it mean? So buyback of share means, what do you mean by buyback of share? Buyback of share means purchase of its own share. So we are purchasing our own share. When shares are bought back by a company, they are to be cancelled. We have to cancel the shares when we purchase our own share. We cannot purchase our own share for the purpose of investment. What does it mean? It means that if I say, for understanding purpose, I am saying that this is the balance sheet of ABC Limited. This is the balance sheet of ABC Limited. So this is a balance sheet of ABC Limited, liability side, and this is asset side. So here what happened? This is the equity share capital that we have issued in the market. So we have purchased. What we do in the buyback, we'll see the accounting later. We have not discussed about the accounting. We will discuss about it maybe today or maybe tomorrow. Okay. So when we purchase our own share, we cannot say on asset side that we have investment in own shares. We cannot do that. We cannot say that investment in own share. When we purchase, we have to cancel it. It is not allowed to show as an investment in our own share. We cannot do this. When we purchase our own share, that have to be cancelled. How to do accounting of it? I will discuss about it. But when we purchase our own share, that have to be cancelled. We cannot say that we have purchased our own share and that will be shown as an investment on asset side of balance sheet. No, it is not allowed. When you purchase your own share, we call it buyback. And after the purchase of your own share, you have to cancel it. You cannot show as an investment. Okay. The meaning of buyback. Now, second point here. Objectives, or you can say advantages of buyback of shares. So objectives or advantages of buyback of shares. Okay. So write it down one by one. You know that. What the first advantage is? You can see first over here. First is to increase earning per share. To increase earning per share. So what happened? To increase earning per share. How can we increase? If there is no dilution in company's earning. It means, you do remember that before the break we have discussed that the profit is of rupees here 2 lakhs only. The profit is of rupees 2 lakh. So the 2 lakh, but here the number of share will reduce on buyback. It reduced from 50,000 to 40,000. Okay. So here, if there is no dilution in company's earning as the buyback of shares reduces the buyback of shares reduces the outstanding number of shares. What happened? It will help to increase the EPS. Second point now, to increase promoters holding, as the shares which are bought back are cancelled. So the shares which we have purchased from outside, that we have cancelled, the promoters holding will increase. Okay, we have discussed about it with example. To remember this. Okay. From 60% to increase promoters holding 75%. Okay. Then after that, third point, write down. Third point, to support the share price on the stock exchange, when the share price in the opinion of company management, is less than its worth, okay, its worth in the market. So to support the share price. Fourth point, to pay surplus cash to shareholders, when the company does not need it for business. It means that when the company has surplus balance, so they utilize for the purpose of buyback. Okay, now next point now. Write it down now. The companies, write down. Is it visible? Yes. The Companies Act 2013 under section 68 subsection 1 permits companies to buy back their own shares, out of, so they can do the buyback out of, first point, out of its free reserve. What do you mean by free reserve? The reserve that can be utilized for the purpose of dividend. We call it free reserve. Example. Let me write down here. Example. General reserve. Profit and loss account, surplus balance. Okay. So we can utilize this free reserve for the purpose of buyback. Second thing, it also permits to utilize the securities premium account. Securities premium account. So what happens is that you can see, when you see this point number 1 and 2, so you know that we can do the buyback out of fresh issue of shares, and out of profit. But these two, when I say, you understand it, out of profit means you are creating the CRR account by utilizing this free reserve, but that free reserve is including security premium. I mean to say that you can also utilize here free reserve including securities premium account, So including securities premium account. Okay. So this is out of these 2 points. These 2 points out of profit. So this is out of profit. And we can also, and second, one more option we have, that is out of fresh issue of shares. So the proceeds from, we can do the buyback out of the proceeds means, remember one thing, face value only. So why I use the word face value? Because companies that the replacement of capital should be with the capital. Understand what do you mean by proceed here? That is equity share capital face value 2, and it should be, proceed should be 2 here. So what happened? Proceed means face value. You will say, no sir, you have received the 3 lakh. No. These 2 lakh, and then proceed means face value. The replacement of capital should be with the capital. If you are cancelling your capital, there should be increase in capital only. So proceed means here, out of fresh issue of shares means, proceed means here face value. So replace, we record capital face value only. So proceed means here face value. Okay. The proceeds of the issue of any shares. And remember one thing, when we do the buyback, we cannot issue the same class of shares. So write down a note on it. No buyback of shares. And this is out of, this point is out of fresh issue of shares. Out of fresh issue of shares. Okay. So no buyback of shares shall be made out of the proceeds of an earlier issue of the same kind of shares. What does it mean? Of the same kind of shares. For example, of the same kind of shares. For example, out of the proceed of an earlier issue, same. For example, equity shares are to be buyback, bought back, are to be bought back, then preferences may be used for the same. What does it mean? If we want to do the buyback of equity shares, here we are discussing about the buyback of equity shares only. So if we want to do the buyback of equity shares, what does it mean? We cannot issue the fresh issue equity shares. Same class of shares is not allowed. If you want to do the buyback of equity shares, I will issue the different class of share. For example, preference shares I will issue. Okay. So preference shares I will issue. So understand this? So we can do the buyback as per the Companies Act out of these reserves and out of fresh issue of shares. So when it is free reserve, we have to create a CR. You don't worry about the entries and all that. We'll discuss about in detail. Now there are various important points. Now give the heading and write down there. Give the heading and write down there. Other important provisions relating to the buyback. Other provisions relating to the buyback. Okay, other important provisions relating to the buyback. Now write it down one by one. Okay, write down first point. First point. Section 68 subsection 2 states that no company shall purchase its own shares or shall purchase its own share or other securities unless one by one. A point. What are the conditions to do the buyback? First condition, it should be authorized by article of association. So the articles, just 1 minute. The buyback, right? The buyback is authorized by its article. The buyback is authorized by its article. Point number 1. So the buyback of shares should be authorized by its article. Okay, point number 1. Now point number 2, that there should be a special resolution. A special resolution has been passed in general meeting, has been passed in general meeting of the company authorizing the buyback. What do you mean a special resolution? Not less than 75%. So at least 75% should pass. When we do the resolution, at least 75% should vote in favor of what? Buyback of shares. Okay. Then third point, C point. Now here point number C, D and E. These 3 points you just have to write it down, because there are some conditions, there are some tests that should be fulfilled when we do the buyback. Those tests we'll discuss about it later, but we are writing all the concept here, all the theory here. So just write it down, point number C, D and E, but we will discuss it later. Just write it down. Point number C. So point number C, there is a resource test. Just write it down. We'll discuss about it later. Resource test. So the buyback must be equal or less than 25% of the total paid up capital of the total paid up capital and free reserves of the company. Free reserves of the company. So don't worry about what is this resource test. We'll discuss about it. I hope you understand first point, that it should be authorized by its article and there should be special resolution. Now what is this resource? And there are two more tests. We'll discuss about it later. Just write it down there. Second now. Point number D. Point number D. Share outstanding test. Shares outstanding test. Shares outstanding test. Write it down. 25% of the 25%, okay, 25% of the shares outstanding. Shares outstanding, okay, 25% of shares. Just write it down. We'll discuss about it. Point number E. Okay, 25% maximum. Yeah, write it down. Just maximum. Add the maximum word here. Just 1 minute. Don't worry. Just add the maximum word here. Sorry for that. Just write maximum 25% of the shares outstanding. Shares outstanding. That's it. Same I have written. Just add the maximum word here. Okay, maximum word here. Now E point. Debt equity ratio. Debt equity ratio. Okay, debt equity ratio. Test. Write it down. The ratio of the debt owed by the company both, write down in bracket, both secured and unsecured after such buyback is not more than twice the total of its paid up capital and its free reserve. Please, point number C, D and E. You don't have to worry about this point number C, D and E. I will discuss about it later. Okay, just you have to write it down, point number C, D and E. Write down one note here also. Note here. Debt here include both long-term debt as well as short-term debt. Long-term debt as well as short-term debt. Okay, just write it down. So don't worry about for point number C, point number D and point number E. We will discuss about it later. Okay, don't have to worry. Now next point, A, B, C, D, E. Write down here F point. F point. All the shares for buyback, are fully paid up. What do you mean by fully paid up? The shares that we want to do the buyback, those should be fully paid up. Okay. Okay. Done. Now write down there below this, provided that no offer of buyback, no offer of buyback shall be made within a period of within a period of 1 year, within a period of 1 year from the date of closure of a previous buyback, previous offer of buyback. It means that in 1 year we can do only buyback one time. In 1 year we can do buyback only at one time. Buyback, if any. These means that there cannot be more than one buyback. It cannot be more than one buyback in 1 year. Okay. So what are the conditions that when you do the buyback, it should be authorized by article? There should be a special resolution. Forget about these tests. We will discuss about later. And the share should be fully paid up. And there should be only one buyback. One time in a 1 year, there cannot be more than one buyback. Okay. Now, you have written this first point. Under first point, all these one A, B, C, D, E, F. Okay. Now, write down here second point. Second point. The buyback may be from the existing security holders. Security means shareholders, existing shareholders. We can there is a condition, there is some restriction when you do the buyback. It cannot be more than 25%. It is written there, and we'll discuss about it in detail later. Okay, so it cannot be more than 25% of the equity share. So from where we can purchase those 25% equity share when we do the buyback? From the existing shareholders or security holders on a proportionate basis. What do you mean by first write down? On a proportionate basis. On a proportionate basis. What do you mean by proportionate basis? Suppose there are 10 shareholders, all of them purchase 10 shares. So proportionate basis, I will take from someone from 2, 3. Suppose I am taking from everyone, I am taking 3 or 2 type from everyone. On a proportionate basis, so overall it should not be more than 25%. Or you can purchase those shares from the open market, from the stock exchange, from the open market. Or sometimes we issue shares to employees also. We can purchase shares from employees also. So by purchasing the securities issued to employees of the company. So sometimes it has happened that we issue the shares to the company, the employee stock option plan we call it. So we issue the shares to the employees. So what we do, we purchase those shares from employees. Okay, so we can do the buyback, we can purchase the shares out of the existing shareholder on a proportionate basis. And what we can do, we can purchase from the open market, or we can also purchase the security which we have issued to employees. So whether we issue the shares to employees, yes, we issue the shares to employees as well under the employee stock option plan. Sometimes when the employees give services to the organization, so organization suppose they work for the 4 or 5 years, there are some periods. So we do a contract with employees. If we work for next example 4 or 5 years, we will give you shares at a lower price. So we give the shares also, we call it employee stock option plan, and sometimes for the services they are providing to us, we give them shares. So we can also issue the shares. So here what we are doing the buyback. We are purchasing the share that we have issued to employees. Okay. So in other words, we are just purchasing our shares. Okay. Now write down point number 3. Point number 3. Where a company purchases its own shares out of profit, where a company purchases its own share out of profit. You know that we can do the buyback out of fresh issue of shares or out of profit. About the accounting entries we will discuss in detail later. Okay. So out of profit, a sum equal to the nominal value, or you can say face value of shares so purchased shall be transferred to which account? We transfer to capital redemption reserve account. So when we do buyback out of profit, the face value of the shares of buyback, that should be transferred to which account? That should be transferred to capital redemption reserve account. Okay. Now write on 4th point. The capital redemption reserve account, the capital redemption reserve account, it should be utilized to issue fully paid bonus shares. So capital redemption reserve account, it is utilized only and only for the purpose of what? Issue of bonus shares. Okay. Now write down 5th point here. Premium. Write down premium. That is excess of buyback price over face value. What does it mean that premium? What do you mean a premium here? I'm not talking about securities premium here. So the premium excess of buyback over face value. Suppose for example, the face value of shares, what do you mean by excess of buyback over face value? Suppose the face value of share is rupees 10 and I want to do buyback. I want to do buyback at what price? I want to do buyback at rupees 15. It means the face value of share is rupees 10, but I want to purchase at rupees 15. That is, we are paying more than the face value. So what we call it, premium on buyback. So that is how much is premium on buyback here. So premium on buyback. How much the premium on buyback is rupees 5. So that is premium. So right, premium on buyback. Can we do the buyback on premium? Yes. Yes, not necessary that if the face value is 10, then you cannot pay the more. We can pay the more amount. The market value is more. We have to pay the more amount. That is the premium, the excess of buyback price over what? Face value. So here bracket close, then write it down. Paid on buyback. Paid on buyback should be adjusted against free reserves or securities premium account. Okay. Don't worry about the journal entries, that we'll discuss later. Don't worry about the journal entries. But what does it mean? What does it mean that we have paid some excess amount? I have paid some excess amount. We will discuss about the journal entries later. But when I pay you the excess amount, what does it mean? Now understand this point. Suppose the face value of rupees 10. I've paid you suppose rupees 15, I've paid you more 5 rupees. So premium on buyback. What is premium on buyback? That I've paid you extra amount. So that's premium on buyback, the extra amount that I've paid to you. It should be adjusted. But it should be adjusted against which account? So it can be adjusted, that is premium on buyback can be adjusted against free reserve, or it can be adjusted against securities premium. Don't worry about journal entries. We'll discuss about it. But remember one thing. When you pay some extra amount, we call it premium on buyback. The face value of rupees 10, we are paying 15 rupees. We are paying extra 5 rupees. That 5 rupees, that is a premium on buyback, can be adjusted against free reserve or securities premium account. And write down one note there. Write down one note there. Revaluation reserve represent unrealized profit, and hence it cannot be used for buyback of securities. So remember one thing, premium on buyback hence cannot, okay, premium on buyback, remember what? So it can be utilized against the free reserve securities premium. And when you do the buyback out of profit, you know that when you do the out of profit, remember, you can utilize only free reserve and securities premium, which is allowed by the Companies Act. Now, are all out of fresh issue of shares. So here you know that when you do out of profit, so we have to transfer to which account? CRR account. So which reserve we can utilize? Free reserve. Here free reserve in this chapter including security premium also. So not accounting standard. Section 68 of the Companies Act permit to utilize the securities premium as well to transfer to which account? CRR account. Okay. Now I am coming to very important part now, that is journal entries. Okay. So there are so many journal entries. So one by one we will discuss about it now. Okay. One by one discuss about. First I am writing here. Journal entries. Okay, on buyback of shares, out of buyback of shares, suppose let's first discuss about profit. Okay, so what journal entry we pass when we do buyback out of profit? Okay, so just 1 minute. Okay, so let me draw for all these journal entries. Let me draw for just 1 minute. Okay, so here particulars, here which account will be debited and here which account will be credited. I know that. First we write on debit, then we write on, for example, bank account debit to equity share capital. Okay, but to make it simple, here the debit side, debit, which account should be debited, I will write here, and which account should be credited, I will write it here. Okay, so don't get confused. What are these two columns, debit and credit? So which account should be debited and which account should be credited? So one by one. Now we are doing the buyback out of profit. It means that we are not issuing any shares in the market. We are doing the buyback out of profit. So first entry, write down first entry, purchase of equity shares. Okay, purchase of equity shares. Understand this. What happens when we do buyback? We purchase our own shares from the market. Okay, when we do buyback, what we do? We purchase our own shares from the market. What entry do we pass here? Okay, what entry should we pass here? Okay, so we have purchased the shares. So which account? We have received the shares. So we have bought back. So equity share buyback account debit. Equity share buyback account debit. Okay, equity share buyback account debit. Okay, so which account should be debited? Equity share buyback account debit. I will debit to equity share buyback because I have received the share. I have received the shares, equity share buyback account will be debited. So I have received the shares. Okay. But for that I have to pay the amount. So which account will be credited? I will credit to which account? Bank account. So I will debit when I purchase the equity shares. Which account should be debited? I have purchased my own shares from the market. I have received the shares. I have received the shares. So I will cancel it. Don't worry. First you have to purchase it. To purchase the shares, equity share buyback account, debit. I have paid the amount for it. So which account should be credited? Bank account should be credited. So I have purchased the equity share buyback account debit because I have received the share and I have paid amount. So which account should be credited? Bank account. Second entry now. Second entry. Okay, second entry. Cancellation of equity shares. Cancellation of equity share which we have purchased at, suppose we have purchased at bracket, in bracket I am writing purchase at par. What do you mean by purchase at par? Suppose the share is of rupees 10, we have purchased at 10 only. Suppose the share is of rupees 10, the face value of share is rupees 10 and we have purchased from the market at 10 rupees only. Now what we have to do? The cancellation of it. So I have purchased the shares, now I have to cancel it. So when we do the cancellation of share, equity share capital will go down. When you cancel the share, equity share capital will go down. You know that decrease in capital will be debited here. So here you will decrease in capital debit. So you will debit to equity share capital account. You will debit to which account? Equity share capital account. So you have cancelled the share, decrease in capital, equity share capital account. So those share you have purchased it, you have cancelled it. So when you have purchased, you have debited to equity share buyback account. Now you are cancelling this. So you will credit to equity share buyback account. Equity share buyback account. Now understand this entry. Don't worry. Just focus here. Now what happened here? What entry we have passed? These two entries. First I have purchased the share. So I have received the shares. So equity share buyback account debit to bank account. Now I have to cancel it. So when we do the cancellation of share, the share capital will go down. So when the share capital will go down, decrease in capital debit, the equity share capital account debit. So again, we are cancelling the share which we have purchased. So when you have purchased it, you have debited it. Now you are cancelling it, so you have credited it. So equity share buyback, ultimately what entry we have passed here? Ultimately you have passed entry, equity share capital account debit to bank account. Why? Because the share which you have purchased, you have debited here, equity share buyback account debit, and you have cancelled it here. Equity share. So you have debited here and you have credited here. So this equity share buyback account cancel here. You have debited here, and then you have credited here. So equity share buyback account debit, you have debited here equity share and then you have credited here. This is cancelled. So what net entry you have passed for it? You have passed entry equity share capital account debit to what? Equity share capital account debit to bank account. Do you remember this entry? Here, equity share capital account debit to bank account. When we here out of profit, equity share capital account debit to bank account. Do you remember this entry? Yes, sir. Equity share capital account debit to bank account. Okay. So equity share capital account debit. Where it is? Equity share capital account debit. Equity share capital account debit to bank account. You have purchased, so you have debited equity share buyback, but you have cancelled it. You have debited here, you have credited, it is cancelled. What is the net entry? Equity share capital account debit to bank account. Now it may happen we have purchased the shares from the market at more price. What do you mean at more price? That we have paid more amount, excess amount. That is the premium on buyback we call it. So it may happen that cancellation of equity shares, purchase at premium. So cancellation of equity share which we have purchased at what? Premium. What do you mean by premium? We have paid the excess amount. So is it possible? Yes, it is possible. We have paid the excess because the market value is more. So we have paid more than the face value. So now understand this entry here. Now what happened here? So when we pass entry, first decrease in capital debit. So I will say here equity share capital account debit, equity share capital account will be debited here. But the face value is of rupees 10. I have purchased at rupees 15. So equity share capital account will not be debited by rupees 10. It will not be debited by rupees 15. Because the face value is of rupees 10, you have paid rupees 15. Remember one thing, capital will always be recorded at face value and face value. So here, equity share capital, suppose is of rupees 10, but you have purchased at premium at 15. So we will debit equity share capital account by rupees 10 only. What about the 5 that we have paid extra, that is premium on buyback? So we will debit to premium on buyback account. That is the extra amount that you have paid. So equity share capital account debit 10. That is the face value. That is the premium on buyback because you have purchased in premium. 2. The share that you have purchased. The shares that you have purchased, now you will cancel it. Equity share. So you will credit to here equity share. Equity share buyback account, and you don't have to worry about it because when you solve the question in next session, tomorrow we'll start the question on it. So all these points will connect it because we have a figures in the question, we have figures there. So we'll connect it. But understand this point here, beta. What happened here? What happened here? So first you have purchased the shares, equity share buyback account debit to bank account, and then you have cancelled it. So when you cancel it, capital will be decreased. So equity share capital account will be debited. So remember one thing. So whenever you debit, it should be debited with face value only. But if you have purchased, we have paid more than the face value. So here you will create face value, and this is a premium on. So premium on buyback. So always share capital will be cancelled at face value because it is recorded at face value only. So we will cancel it at face value only. So we have cancelled at rupees, suppose the share is of rupees 10, it will be cancelled at 10 only. The premium on buy. So here you may get confused. Listen here. You may say that if you have purchased at rupees 10, you have debited here rupees 10, you have cancelled it 10. Suppose you have paid it rupees 15, so you have debited here 15, so you will credit it here 15. Okay, so 10 is for the face value and 5 is for the premium. Okay, so don't worry. When we solve question on it tomorrow, all these points will come there. Okay, so point number third journal entry. Adjustment of premium on buyback. Adjustment of premium on buyback. What is premium on buyback? You can see this premium on buyback. So if this premium on buyback can be utilized, you know that it can be utilized, premium can be utilized free reserve, or it can be utilized against securities premium. What does it mean? It can be utilized this premium, that additional amount we have paid, this account is created, that is premium on buyback. So if you want to cancel it, you have to credit it. I will credit premium on buyback account. So we have debited here premium on buyback account because we have paid additional amount, and we are cancelling it. But it can be cancelled against which? Free reserve and securities premium. So we are writing off against free reserve and securities premium. So you can write it off against securities premium account. So we are utilizing securities premium account, and this reserve has credit balance, and if you want to utilize it, we have to debit it. So securities premium account debit, or you can say profit and loss account debit, it is free reserve, or you can utilize general reserve account debit. I have written here or. Okay, so you can utilize securities premium, you can utilize profit and loss account, or you can utilize general reserve. Now, should we pass entry for issue of shares in the market? The answer is no, because we are passing here general entry for issue for buyback of shares out of profit. So we are not passing entry for issue of we are not passing entry for buyback of shares out of fresh issue of shares. So we are passing here general entry issue of shares out of what? Profit. So remember one thing, beta. Remember one thing. When we do the out of profit, the entry of issue of shares will not come because we are not issuing any shares in the market. But you know that when we do buyback out of profit, we have to transfer the face value of buyback of share to which account? CRR account. Okay. So which reserve we can utilize? You can utilize what? Free reserve. Okay. Or securities premium. So fourth entry. Just 1 minute. Fourth entry. So fourth entry, amount equal to face value of equity shares being buyback transferred to which account? CRR. What is CRR? Capital Redemption Reserve account. So from free reserve we have to transfer to CRR account, and we can also utilize. You remember this journal entry beta? We can utilize this. Out of profit means free reserve including security premium. So reserve has credit balance. So if you want to utilize, you have to debit it. So reserve account debit, we are transferring to new reserve. What the name of that new reserve is? CRR account. So we will debit to here. We will debit here. General reserve, free reserve, general reserve account debit. Or you can debit profit and loss account debit. Or any combination of it. You can debit securities premium account debit. Okay. So this column is of debited. Which account should be? This column is of credit. And we will credit to capital redemption reserve. Capital redemption reserve. So should we pass entry for issue of shares? The answer is no. When the redemption of shares, then the buyback of equity shares is out of fresh issue of shares, then we pass entry for issue of shares. But if it is out of profit, we don't pass issue of shares, we pass entry of this transfer of reserve, utilization of free reserve for the purpose of CRR. Okay. So yes, securities premium. Securities premium account to CRR account. Okay. But what happened? We will also see the journal entry for issue of buyback of share out of fresh issue of shares. Same entry will come. Here, this entry will be same. 1, first, second, third. It will be same. First, second, third. It will be same. But what happened is that, but we have to issue the fresh issue of shares in the market. So that issue may be at par, it may be at premium. But entry number 4th will not come there. Entry number 4th will not come there. Why entry number 4 will not come there? Because when we do buyback out of fresh issue of shares, we don't transfer to CRR account. When we transfer to CRR account, we transfer to CRR account only when we do buyback out of fresh issue of out of profit. So when we do out of profit, then only we transfer to CRR account. So here we have done buyback out of profit. In that case only we have to transfer to CRR account. Otherwise there is no need to transfer to CRR account. But what entry we pass when we do buyback out of fresh issue of shares? These 3 entry will be same. 1, 2, 3. In addition to that, few other entry will come. What entry? That is for the fresh issue of shares in the market. That's it. So now write down journal entries. Journal entries on buyback of shares out of fresh issue of shares. Okay. So we are doing buyback out of fresh issue of shares. Okay. Now write down. Okay. Write down there this debit and credit. Remember one thing, beta. What happened? We will pass entry here in addition to point number 1, 2, 3. Okay, I will write a note here. So in addition to entry number 1, 2, 3. Okay, just 1 minute. We'll write a note here that no need to write it again, or if you want, you can repeat these 3 entries also. Okay, so just one by one. First, we'll issue the first we'll pass entry for issue of shares. Write down here particulars. So first or you can write it down like this. Okay, wait, you can write it down like this. Entry number 1, 2, okay, entry number 1, 2, 3 will come as it is, entry number 1, 2, 3 above, okay, will come as it is here also, above, as it is here also. So 1, 2, 3. Okay, the fourth entry will not come here. Fourth entry will not come here. So, note. Entry number 4th above will not come here. Just 1 minute. Entry number 1, 2, 3 above will come as it is here. Okay, as it is here. Entry, note, entry number, fourth entry above will not come here. Why it will not come here? Why it will not come here? The first, second, third entry will come, but this entry number 4 will not come here. Why it will not come here? Why? The reason is that because we are doing out of fresh issue of shares, so no need to transfer to CRR account. Now some additional entries will come. Now write down first, second, third entry. This first, second, third will come as it is. First, second, third entries, and then fourth entry now. Okay, write down fourth entry now. Fourth entry now. We have to issue shares in the market when new shares are issued at par. What do you mean by at par? Suppose the face value is of rupees 10, we have issued at rupees 10. The entry will be bank account debit to share capital account. Increase in capital to share capital account. We have issued the shares in the market, so we have received the amount, bank account debit to share capital. Or it may happen that when new shares are issued at a premium. So we have issued at a premium, we'll receive the amount, so bank account will be debited. So bank account will be debited to capital will increase, so to share capital account. And the additional, we know that the capital will always be recorded at face value. So if the share is of rupees 10, we have issued in the market at rupees 12. The additional 2 rupees that we have received, that will not transfer to share capital account. That will transfer to securities premium account. So write down here securities premium account. Securities premium account. Right, securities premium account. So this is about the issue of shares the buyback of shares out of fresh issue of shares. The first, second and third, this entry will be same as it is. Fourth entry will not come here. For that, we will not pass entry for the CRR here because we are doing out of fresh issue of shares. So just we have to replace that CRR entry with the fresh issue of shares. So this is all about today. So we'll come to question tomorrow. Just before, just first we do the revision, just in quick revision in 2 minutes. What is this buyback of shares? First, when we issue the shares in the market, it may be preference share, it may be equity share. So here in this chapter, buyback of security, we are discussing about the cancellation of equity shares. So buyback of share is the cancellation of equity share, or you can say reversal of equity share, means purchase of its own share and then we cancel by the company. So here, why we do the buyback? We do the buyback because earning per share increases, EPS increase promoters holding increases, and to support the share price in the market, because the share price which is quoted in the stock market which is less than its worth, so we offer a more price, so we give the message in the market that the value of the share is more than what is quoted in the market. And if you have surplus cash, so we want to do the buyback because we have surplus of cash. We can do the buyback out of issue of shares, we can do the buyback out of profit. What do you mean by out of issue of shares? When we do the out of issue of shares, we issue the fresh issue of shares in the market. Then, but remember that when we solve the question, it will come in detail there. We will do the detailed discussion there. With whatever amount we have cancelled the capital, the same amount we have to increase by the capital. So the replacement of capital should be with the capital. Here out of profit means we will cancel the capital when we do the buyback, but there will be no issue of fresh issue of shares in the market. So, but companies Act says that we have to transfer, we have to create a new reserve account, and the name of that reserve is capital redemption reserve account out of free reserve. You can also utilize securities premium account here also. So we will utilize this free reserve account debit. We will reduce this reserve and we will create a new reserve. We call it capital redemption reserve account. But some of you may say that, sir, we are cancelling the capital here, but we are not increasing the capital here. So there is no replacement of capital with capital. Yes, I agree. But this capital redemption reserve will convert into equity shares only when, because the CRR account can be utilized only and only for the purpose of what? Bonus issue. So later on in future, these shares, capital redemption reserve, will be converted into equity share capital only because we issue only bonus shares out of the CRR account. Now, you know that what is the meaning of buyback? The purchase of its own share, cancel it, and we cannot show our own share that we have purchased as an investment here on asset side. Now, what are the advantages? You know, increase EPS, increase promoters holdings to support the share price and to pay surplus cash we have. We can do the buyback out of profit. We have to transfer to CRR. So when we transfer to CRR, we can utilize free reserve. We can also utilize securities premium and out of fresh issue of shares. Okay. And the same class of shares we cannot issue in the market. So if we are doing the buyback of equity share, we cannot issue the same class of equity share. So for example, now we are issuing the preference shares. Okay. Now, at some important point, it should be buyback should be authorized by article. There should be a special resolution should be passed. And point number C, D, E, we will discuss later. The buyback, the share that we are going to buy back should be fully paid up share. And in 1 year, we cannot do more than. I mean to say, in 1 year, we can do only one time buyback. Okay, there should be a gap of 1 year for the every buyback. And we can purchase the shares from the existing shareholders on proportionate basis. We can purchase from the stock market, or we can purchase the share that we have issued to employees. So, whenever we do the out of profit, the face value of the shares so purchase should be transferred to which account? CRR account. You know it. The capital redemption reserve account shall be utilized only for the purpose of bonus shares. And the premium on buyback, if you are paying anything, that can be adjusted against the free reserve or securities premium account. And revaluation reserve cannot be utilized here. You know that we can utilize only free reserve, that is general reserve of profit and loss account, and securities premium account. Now, what entry do we pass? First, we have to purchase it. So we have the entry pass for purchase of equity share buyback account debit to bank account. Then we have to cancel it. So cancel, decrease in capital debit to equity share capital account debit, equity share buyback account. But we have purchased the equity shares at premium. So when you will cancel it, so we record equity share capital face value only. So when you will cancel it, equity share capital account debited will be debited with face value only, and will debit to premium on buyback, the additional amount that we have paid. So premium on buyback account debit to equity share buyback account. Now this premium on buyback will be cancelled. So you have debited here, it will be cancelled. So we will credit it. So when you will credit it, when you credit it, it can be utilized against the securities premium account, profit and loss account, or general reserve. Now, what's the rule? That the free reserve, that CRR account should be created. CRR account should be created when we do buyback out of profit. So we can utilize general reserve, profit and loss account, profit and loss account, or you can utilize securities premium. Now here, if you do the out of fresh issue of shares, so these three entry will be same: first, second, third. Purchase, cancellation, and premium on buyback adjustment. The fourth entry, CRR entry, will not come here because we are doing buyback out of fresh issue of shares. And then, but here the entry for the issue of shares will come. So if you issue at par, so bank account debit to share capital account. If we issue at premium, so we have received the amount, bank account debit to share capital, and the premium amount will go in securities premium account. This is all about today. So tomorrow when you will come in class, just go through all these points, just do the revision of it, and we'll start question tomorrow. Okay. So thank you so much for today. Take care all of you. Bye-bye.